Good afternoon, traders. It's Bill Baruch with Blue Line Futures, and this is what's moving. The ECB this morning expanded their bond purchasing by more than expected, added 600 billion euros to an already 750 billion euro program. But guess what? The euro continued to surge higher. A lot of these programs that they're putting forth, Germany as well, new fiscal policies, 100 billion euros, and then the budget that's ultimately 750 billion euros with 500 billion going to be grants. Free grants to some of the most needy nations. Still hasn't passed yet, but all of these programs, it's becoming a stew of just stimulus measures that instead of weakening the currency, it's really thought to bring growth over the long term, but then as well coming together, something they really haven't been able to do for 20 years, and getting a budget together and getting that fiscal policy rolled out is seen as a positive for the euro. You're also seeing a lot of shorts in the euro unwind, a lot of longs in the dollar unwind, and that's where you get some of the exacerbated move we're seeing here. But again, we're surprised that you get a larger bond purchasing program or an addition to the bond purchasing program than expected early this morning out of the ECB, and the euro continued to rally on it. But overall, it's bringing risk on. You've seen the stock market stay bid. It hasn't fallen back. This was going to be a day where you would imagine you get a consolidation. The S&P and Nasdaq both gained sharply for 8 days in a row, then melt up. It's really been snowballing higher. You get a day like this is that pause, and I think without additional measures from the ECB, we probably would have seen it go just a little bit lower. If you take a look at the heat map here, I'll show you across the board. They're really, it's no real leadership on there, but the banks again are doing real well. Tech, the big names in tech, they're just taking that breather. They've been leading the way and doing all that heavy lifting for several months now. Just taking a bit of a breather. Real estate not looking so good. Healthcare has as well done some heavy lifting over these hard times, and that's taking a bit of a breather. But you're seeing banks, semiconductors are bouncing back today. They had a little bit of a pause yesterday. So it's, I don't want to call it a rotation. We actually use the name stretch for yield in the Morning Express. But overall, you're seeing just some days you're getting value moved into other sectors and then compared to ones that have led previously. But again, your semiconductors, strong session. Disney, putting some back-to-back good sessions. But again, the banks are really what the leaders here today. And I want to focus on, this is the regional bank ETF, KBE, and this was, if you look here, this big tail last week. Remember, they started off on fire last week. It was the big narrative rotations happening here right now, this stretch for yield, so to speak. Finished on a soft note last week, roaring back here, up 9% this week right now. And it looks like they're going to want to really start covering this gap. This is a big area. We're sort of running into previous lows, but this gap is not really until where that closed on a weekly, 36.28. So can it get there? But, there is definitely some resistance that it could be running into. It's not something we'd want to step in front of by any means. But take a look at the S&P. You're running into, this is strong resistance area we stalled here early March before Saudi Arabia started the price war in crude oil. So the market's up there, still facing that 200. The 200-day moving average is still big support. That's acted as a sort of a platform for the S&P to build off of end of last week. If you remember, we were all pretty worried what was going to happen with on Friday. Was President Trump going to sort of throw the phase one deal out? Were they going to be some harsh sanctions? Instead, the S&P pounded just below that 3,000 level twice on Friday and held that 200-day moving average, ripped higher, and now the 200-day moving average, it's in the rearview mirror, and it's really a big support level. So you do have that overhead resistance that we're running into now, but a lot of support building below. And again, looking at this today being a pause is not much of a surprise. Got the NASDAQ, though. I want to show you some interesting ways to look at it here. Obviously, the overhead highs, and then we're sort of stalling here, too. After yesterday's extension, sideways, but you got this ascending channel. It's not really a wedge, but you got an ascending channel. It is sort of wedging a bit, and it could continue to if we don't come back down at all. But wouldn't be surprised to see a test into here at some point over through the next week. Non-farm payroll tomorrow, we'll get to that in a minute, is going to be an interesting one. But as the stock market has continued higher, we've seen treasuries move lower. Even with the pause today, the 10-year treasury note, the prices have moved lower to a new low. Now, remember, we are in the blue line trade alerts. We do have a short call spread, a 138, 136 call spread we sold, which is a limited risk. We sold that for about $1,600. It's come in pretty well at about a 0.40, 1.40 ticks we sold it for. It's trading about a 1.20 ticks. We do like seeing this come in just a bit here at this point, but we are also long on the 5-year side, looking for a little bit of a steepener. So if you see the curve steepen a bit, the 5 years move up below more sharply upon any type of risk-off scenario, we're positioned there as well. So just an interesting way of looking at things, but looking really to collect that premium on any wave lower and some of the time value coming out of it. But looking back at the charts, interesting thing we talked about this week quite a bit. And here's the 3-year U.S. Treasury yield. The 3-year Treasury yield, 25 basis points right now. Now, remember, we've hit this number of times. Amazon auctioned $10 billion worth of 3-year debt on Monday at 40 basis points. Now, anybody buying that, institutions are just stretching for yield. Anybody buying that is not going to enjoy any upside in Amazon, but it does show you the desperation to find some yield. So as this 3-year gets up there, it's going to be something that I think is going to be in the headlines a lot more next week. If we continue to see yields rise, maybe a great non-farm payroll tomorrow, something in line with ADP, it continues to push yields higher. Those prices are lower. So if you still get those yields higher, take a look. It's going to, you got the 50-day moving average here on that 3-year yield, but it's going to draw attention. Institutions are looking, if they're willing to give Amazon $10 billion, you're going to see some money flow in there. And then take a look at the 10-year. I mean, 10-year has moved above that 80 basis points area we talked about yesterday. And it looks to be having, the next area to look at, we're consolidation, almost about 90 basis points. And, and then really it's a matter of it's the round number, 1%. And that could be in the cards here over the next few months as the situation stabilizes. I mean, to be honest, though, we would really imagine if the yields continue on this pattern, the U.S. dollar has got to continue to rise. I mean, you've got to stop this drop and start to turn it and start to rise. So something to consider there, as we do think the dollar is very oversold right now as that position gets unwound. Now, gold held that sharp sell-off yesterday, and we talked about it too yesterday with the spread between the June contract, the August contract, extremely wide, very abnormal. Tightened back up to a more typical $6-7. June's in delivery though, and now gold's bouncing back here today. Constructive. This is a continuous chart, very constructive. So you can see where what gold really has to start chewing through some of these highs. Leave those tails out. Those tails really I think came on Sundays too, which is the interesting thing. Yeah, actually, all those tails really, those last two tails came on Sundays, Sunday nights. It's not surprising to see gold start to top out Sunday nights sometimes. You get that out of the weekend jolt higher, especially what happened this weekend before sort of falling back. But the construction we've seen here on the bottom side, and that which was resistance on the inverse head and shoulders, is really, really great. But we got to get through here, get through 1750. It's going to really excite the bulls. And silver, I think silver is going to have to do the heavy lifting, as well. It's got to get through here. So some nice higher lows here. Resistance at $19 is there. I mean, we have talked about that trend line that was going to provide momentum. It's got, it got out above there previously. That was something that did help the market. It was important to show momentum, and it gave us a little bit of a head fake. But now you got this resistance here at $19. It's got to get through there. And believe me, I do think if silver gets through $19, it's going to run another buck or two very, very quickly. So keep that in mind. Now, moving on to crude oil, there's a number of lines I drew on this. So this is support now. This was previous resistance, $35. That is now support. Still working to try and chew through 37 and a quarter. Can it And that's the question. You got 50% retracement, about $40, big round number. Got the gap cover, about 40, 42, 41 and a half dollars. That's going to be an area that if this continues, it can really chew through here, 37 and a half, which is where it's going to run. Now, an interesting thing, we tend to are believing, especially after yesterday's big build in distillates, that heating oil is really lagging here, and it's right at a 110 area, which seems to be stalling. Previous little bit of a resistance April 2nd, but before it broke down. So an interesting way to potentially look to do this is selling heating oil, being short heating oil and long crude oil in case there's a reason that energies do start to rally. That spread can still work out. But if things start to roll over a bit, we do think that heating oil is going to lead to the downside. So we do like that idea, getting exposure in heating oil short by being short heating oil, long crude oil, because when you go to get gasoline and heating oil, those options just really are not liquid enough to take calculated risks in and be able to feel comfortable with what you're purchasing. So one of the ways to do that maybe would be looking at the crack spread. We're here to help. Give us a call. We'll talk about that. And then lastly, touch on the currencies here. This euro, as I said, it keeps ripping higher, but something to keep an eye on. Got a trend line going back to 2018 and then this March high, running into that today. So there is this massive unwind going on here. Shorts covering and in the euro, and now it's at resistance. So keep that in mind as we head into tomorrow. Non-farm payroll. And then the Aussie is another one we've voiced that we'd like to that think was going to roll over. It just hasn't. So we're not going to be right all the time, but overall. There is a support where if the Aussie is seeing some tails here last night as well, a new high couldn't hold it. There's a support. It's where we would look to imagine this thing coming back down to pretty quickly, 67, if the U.S. dollar could firm up, 200-day moving average down there as well. Now, where the Aussie chewed through this, the Canadian dollar hasn't, and it is fading, is facing that now. You got the gap here, you got the 200-day moving average, so a lot of resistance here in the Canadian dollar, something that's really on our radar that we actually like looking for exposure in the Canadian dollar to the downside. Now, tomorrow, like I said, U.S. payrolls, non-farm payroll tomorrow. Looking for a drop of 8,000 jobs. ADP payrolls, the private survey on Wednesday was much better than anticipated at 2.7. Again, we're surprised that the U.S. dollar couldn't firm up at all on that. It's just, again, I guess, everybody's really focusing on the massive stimulus measures from the Fed. And although the market had not reacted in the currency side recently, you're seeing that unwind now because of it, even though all central banks are really have really unloaded something, it's the Fed that's done the majority of it, and they're supporting the entire globe. And in the long run, we do think that's going to be why the U.S. dollar does rally. But for now, again, you're just seeing this massive unwind here, and the dollar's under pressure. So jobs from the U.S. tomorrow. You have factory orders in Germany very early, and you also have jobs data coming from Canada and IDPMI. So keep the Canadian dollar on your radar. We're here to help. We're here to talk about anything. Give us a call, 312-278-0500. And remember, futures trading involves substantial risk of loss. It is not suitable for all investors.